Good afternoon. This is Ken Long from Tortoise Capital Management with the review of the daily trading plan and market health check for February 9th, 2012. The vertical blue lines represent 10, 20, and 30 days of look back. The solid purple line at 137 is the swing high that we came very close to testing today. That's a swing high from last year. The solid horizontal red lines are previous support levels that have held. The black line in the center is the 30-day regression line. The outside black lines are the regression channel formed by the maximum excursion from the regression line. And we have a very tightly ranged bullish market here. We're in bull quiet market conditions. We tested the swing high near 137 today. We're right at fair value based on the regression line, so in other words, we're in line with the general slope of the market. Price is better than the 10-period moving average, better than the 50-day moving average, and the 200-day moving average. You can see both averages in price are beginning to leave the 200 behind, so this is expanding bull quiet. On a Williams percent R basis, we are still overbought, and we can stay overbought for a long period of time. Today, we saw a little more fear in the market than we have in the past, so we're starting to feel a little bit overvalued. Percent price oscillator is similar to the MACD histogram. The jaws are still open, pointing up, and that's still bullish. It suggests that we can get through 137 and past 140 on this leg up. The slope of the regression line is sloping upward, and it's above zero, so that's very favorable. These red blocks represent 5, 10, and 15% pullbacks from the swing high. What that means is if it fails here at resistance at 137, we could see a pullback to about, 130, so a 5-point pullback to 130. The next 5-point pullback would be to 123. Anything between 0 and 5% from the swing high we consider to be noise, normal market breathing. Between 5 and 10% would be a correction in a bull. Anything beyond 10% would start getting called bearish. We will stay in bull market conditions till we're about at 125 or 2% above the, or I guess 126, where we'd be 2% above the 200-day moving average. So we have a quiet bull marching northward. Today was a little more panic or fear than we've seen previously this week. There was some serious selling pressure into the close. So we'll see. It's a bull market until proven otherwise, however, and you still want to be long in general in this market. Moving on to the daily trading plan. Bullish quiet is the condition. We are at 62 on an annual basis using weekly RSI 14, so high end and normal. 103 on the 10-day look back period using the 10-day NDX, so 103 means we closed higher than the previous 10 days trading range. Slightly overbought then, a little bit of a breakout. Percent stretch above the 200-day moving average is at 8.41. That's coded green and bullish, so that's a very strong indication of the market's trendiness. The slope of the 50-day moving average is at a positive 1.37. That's also coded green, very strong, very bullish. ADX at 32.7, so we're at the high end of normal for trendingness in the market. ATR percentage declined to 1.01, so it's quiet. You can see over here on the volatility chart, we are at the very low end of the 6-month range, and it's kind of stabilized right around 1%. That's very favorable for the long side. No signals in overreaction or channeling. You can see the pivots for reference. Coming back up to the gap stat here, we have 14 times in the last 30 days the market has gapped down. 13 of those 14 times it has closed higher, a gap in reverse, and only one time has a gap down continued to fail further. The gap up 10 times it has gapped up and then reversed to close lower. That's what happened today. And then 6 times in the last 30 days it has gapped up and then continued to gain. So right now the gap and reverse is the dominant trend in the market. 75% of the time in the last 30 days, gaps have been reversed. So we'll continue to play that as the primary pattern. We've been overbought for a while and can stay that way, as you can see on 10-day NDX. 10-day min pains, these are the strength leaders: United Technologies, Bank of America, Microsoft, 3M, and Travelers. Among the ETFs, it's Technology, Taiwan, Germany, and Dividend 100. 10-day max pain, these are the percent losers. In the Dow, it's ExxonMobil, Alcoa, Merck, Cisco, and Coke. And on the ETF 100, natural gas, the VIX, gold miners, treasuries, and metals and mining. We have only a couple patterns that fired for swing systems: channeling signals for treasuries and Johnson & Johnson and Merck in the Dow. We have a triple screen on Merck also. Auto Framer, the only thing that tests out at 2 to 1 or better is TLT, treasuries. And a summary of the Dow tactical report says basically the same thing. A handful of dojis: McDonald's and Home Depot. Home Depot was very strong today, had a strong afternoon run, and it's been positive on every percent look-back period, and was really strong over the 3, 6, and 12-month period. So that's a candidate for some momentum tomorrow. Because it's a doji, you can actually get a tight stop on a range breakout. McDonald's also a doji today. Boeing, IBM, and Travelers all had dojis formed. Those symbols in red are the ones that were the percent big losers today relative to they were exceptionally big losers: Hewlett-Packard, Caterpillar, JP Morgan, and Cisco. The 2% winners: United Technologies at 2.5% and American Express at 1.3%. Same setups looking now at the ETF 30. And again, a handful of dojis, including natural gas, utilities. The S&P 500 itself was a doji, meaning exceptionally small range, and then with the open very close to the close. So a moment of indecision, taking a natural pause here at the top of its channel. This would be a normal place for it to either gather strength and explode upward through resistance, or to bounce off that channel at 137, and then the next target on the downside would be 130. VIX was the percent winner today, turning in almost 5%. Agriculture was the percent loser at minus 0.8. Treasuries test out at a 3 to 1 reward to risk ratio using the Auto Framer technique. Looking at the fraud candidates, those in green are exceptionally reliable and directional. So there's about a dozen of them that are above the critical level of 3.0. What's nice to see is IWM, the small caps, and the Qs, and SPY is actually pretty high at 2.9. That's very direct. It's been very directional and reliable. We like that. Fail stat for references. I won't read the chart to you. And the signal to noise ratio, again, just for reference. I won't read the chart to you. Looking at the market mosaic, the regression line still stays steady and strong with R squared at almost 0.94. And the regression line is actually improving enough that it's almost crossed back above its 10-day moving average. When it's more than one standard deviation away from the mean, like it is here, it's vulnerable to reversals in the market. This is a level, when we're looking at price relative to the 200, it has reversed in the past 3 times. So there are a number of reasons to be concerned about a potential intermediate high being put in here. So even though it's a bull market and quiet, pullbacks are definitely possible. Again, 130 would be the downside target. And that's those are all the charts I want to cover today. This is Ken Long for Tortoise Capital. Keep your risk measured and powder dry.